Hey everyone, and welcome to today's presentation on the modern wealth formula. So today we're going to cover a little bit about what we've been finding with a lot of our clients, frustrations about wealth creation in the modern era. So the game has really changed over the last decade, right? And I think in order to invest successfully in the modern market, you've got to adapt to the new situation. So, what have our clients been finding frustrating, and what value can we offer to people who are interested in investing in the market to really succeed in their investment journey in this day and age? Now, the old wealth book is breaking. So, you know, at the moment, there's a lot of frustration where, something that a lot of Australian investors are familiar with is property investing. It's been the largest wealth generator over the last 30 to 40 years, but it's become too expensive. So people are being priced out of the market, and younger investors are finding it incredibly difficult to enter with a larger deposit that needs to be put down. But also at the same time, for people who are looking to retire and who've built their wealth through properties, they are looking for other solutions outside of property so they can actually diversify away from the property market. Now, shares obviously presents a very good opportunity and a different asset class where you can actually create wealth. But it also has its downsides where, for example, if you're investing in a stock picking portfolio, a lot of people are active in choosing stocks that they like or themes that they want to get on board. But a lot of times they're not immune to really significant volatility. Of course, in the Australian market recently, we've seen that CSL, Cochlear, a lot of these stocks have experienced, great volatility, and it's been a difficult journey for investors to kind of get around. So the other problem is for people who are looking for income. Interest rates are very low, and it's fairly difficult to find an instrument that can keep up with inflation and generate real returns. And to top it really all off, I'll talk a little bit about this. The budget that was released by the Labor government 2 weeks ago, it's really shifted the way that investment will continue in the next couple of years. Right, so there's been substantial changes to the capital gains tax as well as negative gearing. So investors are really rethinking about what they should do in the market to actually allow their portfolio to grow. So really the question for today is there a better way to build wealth that's geared for today's markets? And I'll be covering a little bit about how we created a solution for our existing clients and how that's worked for them, where it allows them to capture more of the gains when the market is performing well. But even when the market is not performing well, you are in a safer position and you have a cap floor to where how much capital is at risk, right? But before I go into a lot of the ideas behind it and also the products and the solution for this problem that we have, is I'll explain a little bit about myself, and I'll explain a little bit about how we came up with the idea and solution for the clients. Right. So my name is Kai Chen. I started MPC Markets with Mark 3 years ago. But my journey began as a prop trader. So I was a keen investor, in my early days, and I enjoyed the market. I loved the experience. Every day you come in, it's a new experience and a new challenging market. I managed to succeed and create a good career out of trading. When I was a prop trader, I was one of the top graduates in that. And also I moved on to a algorithmic trading firm, which for the people who are out there don't know what we do, is basically we go into the market, we find an opportunity and the patterns that exist in there. We do the research, prove that the strategy works, and then we automate this idea. So I led a team of about 7 traders, and we built the desk up to about $300 million by the time we left, right? But MPC really defines a really good opportunity because really our goal is to actually help mum and dad retail investors out there to find a better strategy that suits their need. Now, that's a really important part of our philosophy. We want to bring the research and institutional tools out there that's available to, these institutional players out to the real world and actually beat the performance of index managers, right? So Just to give you a little background of what I've seen is possible. When we're talking about these big algo firms, they can achieve returns of about 60 to 100% in a year, but that's not easy to do, right? You need the technology, you need the research, and you need the capital access in order to do all of that. But however, even though we might not have the set of complete tools, we can actually use a lot of the research and ideas behind that and the investment products behind that to achieve much better returns for our clients. So I'm going to talk a little bit about that on how we can actually improve the performance of the portfolio. But before I get onto the product side, I really want to talk about how we came up with these strategies and who this is relevant for, right? So the first thing I want to talk about is property. So in Australia, I think everyone is familiar with property investing to some form, whether it's someone in their family or themselves investing in property. It's created a lot of wealth, right? But I want to dispel the misconception where the property, the asset, is the thing that creates the growth. It's actually not the asset, right? And also the misconception that property from its real returns outperforms the equity markets. The equity markets actually has a higher return. The second thing I want to talk about is basically the the takeoff the ETF investments, right? So for people who don't know what ETFs are, it's called an exchange traded fund. And basically what they do is they take the job of diversifying, holding a large number of companies into their fund, and you can purchase this fund to be diversified and invested, right? So how did we come about property investing and taking inspiration from that? So, for us at MPC Markets, we specialize in stocks and structured products, but we do have a lot of people who are invested in property markets and going out and speaking with them. And in my specific case, it was a very interesting story because I met up with an old high school friend who is an avid property investor. And he's done really well. He's paid off his house in a suburb in Sydney. And I was quite shocked by that because, it was actually a quite nice property that's valued in the millions. And, I asked him, I was like, oh, wow, you've done incredibly well. How did you gain this wealth, right? And he said, I've been in the development game. I went from property and property. It's grown well. I've done well. But really, when I went back and kind of thought to myself and did the research, I really broke it down in terms of why this happened, right? So the misconception is that in property, the wealth is generated by the property growth. And I'm not saying that you can't find a great property that grows at 20, 30% a year. These are possible. But on average, if you buy a property in Australia, in a capital city or regional, the growth is not incredible, right? It's actually lower than what a stock market performs at. But what allows that wealth creation is actually it's the loan. So, I've put a very simple example in this case where if you had $100,000 and you bought a $500,000 property, which in most property cases you have to put 20% deposit down. There's lower amounts of deposit that you can put in, but we'll use 20% as the deposit amount. If it grew to $895,000, you've had a 2 times return on your return on capital, right? So really, it's quite interesting because the leverage effect on that house creates that wealth because you've only put $100,000 down and you've made $300,000 out of that because the notional value of the house has grown, right? So this is a very important concept to understand, and it's really, it's a really valuable tool to create wealth, but you have to use it in the right way. Right? Because if you buy it on a poor asset or an underperforming asset, in the long run, that's a bad decision in terms of investing. So we want to find good assets where we can actually get leverage on. Now, the second misconception with equity versus property is that the property market outperforms in terms of returns against the equity markets. So over the last 20 years, from statistics, property has grown. This is before costs, about 9.1%. And obviously, if you're really taking the net returns, it's slightly lower because, you've got to factor in the maintenance costs, strata fees, all the other costs associated with housing. But equity markets actually in the US, the S&P has performed at about 10.5% over the last 20 years. So really, when you look at it from a statistical point of view, equities is actually a higher performing asset over the longer run. Now, the second part of the inspiration for the strategy is, let's talk about ETFs, right? So index investing in ETFs. This is a thing that's become really popularized over the last 15 to 20 years. And, it was fairly obscure, basically 20 years ago. But really the idea came back to research that was done in the US, right? So what happened was that basically they did a bit of research in the US to compare active fund managers versus passive fund managers. Now, the difference between the two is that for a passive manager, you have a benchmark that you are performing against. So, to put a very simplistic example, you're competing against the S&P 500, right? Or you're trying to replicate the performance of S&P 500. For an active fund manager, the benchmark is a bit more loose, right? So you're actually looking for real returns above the market. But it's actually incredibly difficult to achieve. I've seen this done before in my previous career as a quant trader, right? It is possible, but there's a lot of research, a lot of access that you need to have. For example, technology access, infrastructure access, capital access. That's really not easy to get. And it's not an easy task to achieve. So for the majority of investors, the easy route and the most taken route to achieve consistent returns is actually to invest in an index and to go with passive ETFs. But let's understand a little bit of why that happens, right? So, the key thing to understand is that when you're index investing, you're buying into a basket of stocks. So in that basket, for example, the S&P 500, you are buying the top 500 companies in the US, and they will, they are the 500 best performing companies. Now, the thing that really keeps the upward growth over a long period of time, and the secret sauce to the index is actually that there's a rebalancing mechanism. So generally on a quarterly basis, the underperforming companies gets taken out of the index, and basically the growing and outperforming companies get put into the index. So that's really what creates that asymmetric skew over a long period of time. If you're always buying the best quality companies, generally it's going to tend to outperform. And the other thing that ETFs have going for it is that the costs are very low, right? So you could be looking at anywhere between 0.05 bips in terms of cost paid on the ETFs to, save 0.3 or 0.4 on the ETF, depending on which provider you go with. So from a cost standpoint, it is actually quite attractive. Now, this is a really good solution, and that's really resulted to this incredible growth in the ETF industry, especially in Australia, right? So compared to where we were 15 years ago, it's grown from under $50 billion to $300 billion, which is a substantial uptake. So, it definitely works, and a lot of investors are going into ETFs. But really, there's a couple problems that we find with ETFs, and a lot of things that investors raise, and these are kind of common questions that investors ask or struggle with or complain about. Is that this one applies for younger investors, I guess, especially. It's too slow. So for ETFs, if you invested $100,000 over 10 years, if it performed at 10%, it'll roughly be at about $600,000. And usually the comparison is against properties where, you have the upside growth of it and you're building wealth a lot faster. So there's almost a fear of missing out where you're going, okay, well, my friends bought property, I bought ETFs, they've outperformed me. How do I actually get similar types of performance? Right. The second set applies probably more for retirees or pre-retirees who've built their wealth and is looking to protect their wealth. With ETFs, it's a lot more difficult because, it is more volatile than the property market. And, for a time where the market is underperforming, it can be incredibly scary, right? So if the market corrects 40% and you've got your whole portfolio in that investment, it becomes fairly risky because you look at it, and if your net wealth is $1 million, it drops 40%. You've lost $400,000. Although in the long run it does outperform, there are periods of volatility where it's incredibly hard to hold on to, and selling it may be the wrong choice. But a lot of people get trapped into selling out when you have these massive corrections. The third thing about ETFs is that you can't really design the product to be specific to what your goals are, your wealth building goals are, right? And everyone has different wealth building goals, and it's up to you to understand that or consult a financial advisor to plan that out. But once you have that planned out in your goals, you want to find instruments that can represent your goals well. And the last thing to consider is capital efficiency, right? So do I really need to invest $100,000 in order to get the same exposure, right? So there are better ways and tools to represent this, and I'll go through a little bit more when we talk about products. So traditionally in the industry, when we talk to a wealth advisor, most of them try to categorize people into one of two camps, right? You're either in the income camp, and in that case, the majority of your wealth is working for you to create an income or to create yield or a dividend, right? Or the other camp is basically a growth investor, typically younger people who are trying to grow their portfolio, and they want the upside. But the reality is, it's not a fact of choosing whether you're one or the other. The real question that we should be addressing is, how much do you want of each, right? And really, what is the outcome that you want to achieve, and how much do you want to put into each pool? So this goes onto our strategy. So our modern wealth building strategy, really the goal of the strategy is to create clarity for the investor. We have two pools to keep it really simple. One pool is for capital preservation and to derive income. The other pool is to actually grow. But the benefit of actually splitting it into two pools is that we can do each one of these jobs very well, and we can select products that does specifically what it is designed to do, right? So I'm going to talk a little bit about the products that we can use to put into these pools. For us, we specialize in structured products. And these are the tools that institutional players really use to create a skewed return profile, risk to return profile. And it's really important to understand because with the same amount of money, you can be getting better results. And the structured product industry is massive globally. So in the last year, in 2025, it did about $1 trillion of placements. And it's really taken off in Europe. Europe is a place where most of the structured products, there's substantial amount of volume, and it's actually quite a high composition of most investors' portfolios. So it goes up to as much as about 19% of the average investor's portfolio. In the US as well, it's incredibly popular, and Asia, it's also picking up for thematic trades, right? But for Australia, we're a little bit behind the game. At the moment, it stands only at $3 billion a year in terms of placements, but it's really picking up pace and it's really growing in industry. And I think it'll be a shame that for sophisticated investors out there in Australia who are looking for better tools to represent their views and investments, they need to understand what's available out there to achieve that better return. So I'll talk a little bit more about pool one first. So pool one, the idea is that we want to create the pool. It is designed to generate us income and to preserve our capital. We want to minimize the risk of losing our capital in this basket, but we want to squeeze out a bit of extra yield, right? So traditionally, if you wanted to take a no risk investment in generating income, you can either put it into a savings account, a term deposit, or your offset account, right? These are generally more risk-free, but if you wanted to derive a higher yield on your portfolio, you will have to take slightly more risk, but we can tailor it to the yield that you want to. One of the instruments that we use quite often is called the fixed coupon notes, and really what happens is that you get paid an income on a monthly basis. And the underlying basket that this product is tied to is generally blue chip stocks. So it could be, for example, BHP, Rio Tinto, Fortescue Metals, or a bank basket, which is something that we offer very consistently, right? So for example, a bank basket of four, ANZ, CBA, NAB, Macquarie, that will generally yield around a 10 to 11% return on that asset over a period of time. The maturity profile is generally about 2 to 3 years. And then how it works is basically if it remains above a barrier, and in this case, let's just use as an example, 40%. If all the stocks started off at $100 and they remain above the barrier, you will continuously get paid per annum, around 10% with monthly distributions. So it's an incredibly great tool where you can actually increase the yield on your conservative side of the portfolio and get greater yield. We use that in combination with other debt instruments, whether it's term deposits, whether it's other safe debt instruments. And the overall yield, our goal is to achieve, about 7.5% to 8%. So that you have the protection as well as some income coming into your portfolio. The second pool is the growth pool. So this is actually really the interesting part, and this is really the engine behind the idea. So as we talked about earlier before, property is the greatest inspiration for these tools, and the property investors have really found something that is applicable over time, right? So on a growing asset and a quality asset over a long period of time, if you can gain leverage or higher exposure to that, be capital efficient with it, you will derive higher income. So in the equity space or in the structured product equity space, the product that is equivalent to that is called a deferred purchase agreement. And I'll explain a little bit about what they are, right? So it's not too dissimilar to a home loan. So what happens is in this example, let's just say, for example, if we paid $17,000, we can get an exposure of $100,000 on an underlying asset. And that asset can be an index. And basically, if I put down $17,000, I get $100,000 of S&P 500 exposure. Over 3 years, if the index went up 30%, by the time it gets to maturity, I will get paid $30,000. So you've made $13,000 above the original $17,000 that you put in. And the great thing about this kind of product is that it's actually a loan with no recourse. So basically, you can't lose more than the capital that you put in, that $17,000 that you put in. However, it does give you that upside exposure. So this is how we create the asymmetric risk return profile, right? And the other benefit of it being a loan is that there is a class ruling, a product ruling from the ATO to say that the prepaid interest on this loan is tax deductible. So it is also tax effective as an investment. Now, as a combination of the two, this is where we really get to see the power in play, right? And really in this example, what we're trying to portray here is our version, the MPC strategy in using structured products to construct a portfolio against an ETF index, right? So in this example, what we're doing is we have $100,000 to invest. We're going to put 60% of the portfolio into our conservative capital protected pool, and 40% we're going to put it into our growth pool, where we're going to use leverage and the deferred purchase agreements to get exposure to an index, right? And we can create that exposure on an index such as the S&P 500. Now, as you can see, it creates an incredible profile because with the deduction in there, as well as the limited downside on that growth part, you know exactly how much you're going to lose, right? And then you've also got the income side, which is generating income, which is covering the downside. So this is why it's created the case where, for example, if the index drops 15% over a long period of time, you know where your floor is going to be, right? And I'm not making a guarantee on the debt aspect of it, but it's a different type of risk. It's not market related. It's debt related. So, in this case, what we have created is on the downside, if the market drops 15%, if you invested $100,000 in an ETF, you would lose $15,000. But in this case, over 3 years, you can be slightly up. In this case, I think it was about $1,100, right? So even in a market that underperforms significantly, you can preserve your capital to what you've invested in, right? But the beauty of the other side of it is that if we actually do well in this market, the market actually grows by 10% per year. Over 3 years, you would have doubled the returns of what you would have got on if you invested in the S&P 500 ETF. So, just to really clarify and show the examples in dollar values, in a really bad year, you're still up about 1,100. Compared to the index, you're up about $10,000, right? But on really good years, that's really where we see the strategy kicks in. It has a multiplier effect on the gains on an index. So, it's a really staggering formulation, because in this case, we've achieved both our goals, where on the upside, we're actually getting more of the gains. On the downside, we've created a floor where your risk exposure is known and you can control that factor. So this is really the benefit of the MPC wealth building strategy, right? Because you can tailor it to what your financial goals are, right? For whatever outcomes you want to achieve. And we can help you find the right products that can achieve that goal. The secret actually is really understanding the allocation and really what you want to achieve with your goal. So I'll go through a couple of these standard settings, but really the point to really point it out is that it's as flexible as you want it to be, and you can really allocate. You're in control of that allocation or how you want to represent your goals. So for a conservative person, so for example, if you're in that retiree age, or you've built your capital, you're looking to preserve your capital but generate a good bit of income and still have a little bit of growth, you can keep up with the index. You can allocate anywhere between 0 to 20% in that growth portion, and that will represent, not 0%, but if you invested 20% in that growth bucket, it will allow you to actually keep up or outperform the index slightly, right? So for someone who's looking for a balance setting, right, you put 20 to 40% of the portfolio in growth, and that really allows you to achieve that multiplier effect on your returns. So if the index goes up by 10%, you're getting about 19% returns on the capital that you've invested. And for people who are more aggressive in the growth phase, so for example, if you're a younger investor or a person who is willing to tolerate a higher risk profile, you may want to actually get more leverage and actually grow your portfolio faster. So this strategy and framework really allows you to do that and tailor it to your specific outcome that you want, right? So I'll finish off the presentation with a final slide to really just demonstrate what the power of time is, right? So we all know Warren Buffett and Berkshire Hathaway's story, and it's an incredible story. But really, when we break down the details, it comes down to two things. Compounding is always king, and time, right? But also consistency over time. And, I've got a chart here just to show you, for example, if we've invested in the market at 10%, and we got let's say a conservative, allocation, and we beat the market by 6% a year per year, over a 15-year period, that results, if you only got 10%, you'd from a 100K investment, you'd get about $420,000. If you invested it at 16%, you're at $925,000. So you're almost $500,000 better off over 15 years. And it really shows you the power of compounding over time, right? And the consistency of returns. This is really the key power of all investing, whether you're in property, whether you're in shares, any asset class. We want to have, even a small amount of returns extra over time makes a massive difference. And with this wealth creation strategy, because we can define the floor and we can also amplify our gains, we can achieve higher returns with a safer setting. So, if what I explained today is relevant to you, and I know it's a lot to take in over just this period of time, and I'm sure there's a lot of questions, but the key thing is you want to see how this works for your portfolio. So, if you have any follow-on questions and you want to see the actual numbers behind on how this all works, that works for your situation and the design, the outcome that you want to design for yourself, please give us a call and we'll do a portfolio review and we'll show you how this strategy is implemented and what it actually means for you, right? So, and then, if you are happy with what the design of the strategy shows, then we have products in which, we release usually a deferred purchase agreement purchase or index investment purchase every month or two. So feel free to call us in and see what we have on offer. Now, I appreciate you joining for the presentation, and I hope I've created something where we're able to show you a new solution to a dynamic market. Thank you.